All right, I got 9 o'clock. We do not have a quorum today, so we will not proceed with the agenda. However, we're very happy to have our friends Pazina here. So, gentlemen, good to see you again. I'm sure you have lots of good information for us. As you know, we like to ask a lot of questions, so
Absolutely.
it's okay if we kind of interrupt you. If you have questions, we'll kind of go through that. So,
Please do.
the floor is yours, gentlemen.
Terrific, appreciate it. Great being here again. And, you know, I looked at the inception date, and we are on our 22nd year together. So I just, you know, it's a great privilege, and it's been a great privilege for me to be involved all these years. So thank you for that. You know, let me start with maybe a quick firm update.
Yep.
And there's actually a lot of very good, exciting information on that from Pazina this year. So let me start with our ownership. And you may remember about 20% of the firm, we're a partnership. And we took about 20% of the firm public about 15 years ago. It was back in 2007. We took that piece private back in October. Actually closed that deal October 31st. Bought that 20% back in from the public, so now we're a completely private firm. And I would say universally high praise from both the client and the consultant community on doing that. So, and we have 72 partners in the firm and continue to make new partners, so it's full steam ahead. So
This may be a biased question because you guys just went private, but what your just professional opinion on, over the last 20 years, Wall Street, a lot of partnerships. I think what Bernstein was like the last
Yep.
one that fell, or I mean, changed to a public. I'm just curious, as running a business, the dynamics of having partner capital on the line for decisions rather than other people's money from the public. I'm just kind of curious your observation about how that dynamic has functioned.
well, you know, when you think about what the headset has always been for the firm, we've always, even though we've had, I'll call it public partners in this, we've always functioned with the headset of a private firm. And, you know, what you would think possibly is, you know, oh, do you get pressure from the shareholders to maybe, you know, when value, all we do is value, right? And sometimes value is out of favor, and do you get pressure from the shareholders to do something different or change what you're doing? And we never experienced that, which I think is a really big positive, and for our clients particularly. And so we never really faced that, and part of that was because we also had supermajority voting rights with the partnership shares. So in that sense, I don't think we ever felt the pressures of the typical kind of public company. So we've always had the partnership, you know, as kind of the foundational aspect of how we run the business. I mean, John, do you have anything else to add to that?
Yeah, I think also, even when we went public, that was, you know, a retiring shareholder and a seed founder selling their shares. We didn't take any capital from the public markets as a part of that. So, you know, whether it's, you know, new products we've launched like emerging markets over time, we are very slow and deliberate with our capital because it is our capital, right? So seed capital, being deliberate, going slow, making sure everything's lined up. I mean, that's been our mindset the whole time I've been here, and it continues to be as we move forward.
Right,
So,
and not deviating from who we are.
yeah,
So,
you know,
Okay.
making splashy big bets here and there.
I was just curious. I appreciate
Yeah.
it. Go, please continue. I
Yep.
don't want to interrupt you.
no, absolutely. And then on the team side, very exciting things happening there also. The succession process continues at the firm, and effective January 1st this year, Caroline Kai was named our new Chief Executive Officer, and Allison Fish was named our new President. And that was, Caroline stepped into the shoes of Rich Pazina, who was previously CEO, and Allison stepped into the shoes of Bill Lipsy, who you maybe have met along the way, that was President previously, both of them being founders of the firm. Rich continues to be fully involved as co-CIO, chairman, he's portfolio manager on a number of the U.S. strategies. Bill also continues to be involved as vice chair and also involved in client and client services. So it's a gradual process. It's been happening over many years. We continue to do it in a very methodical manner. And I think the big message here is Caroline's been with us 17 years, has come up through the ranks in managing portfolios, research analyst. Same thing with Allison. She's been here with us 22 years, was very involved in launching our emerging market strategy. So we've always been an investor-led firm. We will be an investor-led firm for the next generation. So I think it's just all really positive news. And beyond that, firm is doing very well. We're $52 billion in assets under management. We've seen positive net flows for the last 6 consecutive years, 9 out of the last 11. A lot of interest in the strategies. The past couple of years, the net inflows have been dominated more by international and global and emerging market strategies, but we just had an inquiry the other day for U.S. small cap. So, and no change to what we do and who we're doing it with. Same portfolio managers, John Flynn, Evan Fox, and Ben Silver. So that was what I had on the firm side. Any questions before we launch into John's segment?
Seeing none, proceed.
All right.
Okay.
Well, thank you. And thank you all for taking the time and having us down. We always appreciate the chance to come down. I think if you think about the past year and even the past couple of years, volatility certainly comes to mind, and kind of waves of uncertainty. Think back to last fall, the third quarter, where Europe was about to fall off a cliff, and the market just completely sold off, and then sanity kind of returns as results come out and people focus on fundamentals. And we seem to be going back and forth on that as well. When you think about this calendar year, January and February were fantastic, and then we had Silicon Valley Bank, which I'm sure we'll talk about. We have the banks in the portfolio. We'll get into the details there. And you had this pullback, and you have this very narrow market leadership now that you've seen from kind of these large cap tech stocks. And so when you look at the first quarter, it's actually it's a stunning stat on page 13, right? Just looking at the Russell growth versus value, the 1,000 index, it was the third worst quarter, going back to 1979 of relative performance. And these things, we still think we're in a very attractive value cycle, and I'll get into some of the part of the value cycle, I'll get into some of those details. But these types of pullbacks are typical. You can go back and see it. Second quarter 2020 also a period where value underperformed. You go back to 2000. I think it's or 1999. You see it. We all know what happened subsequently. So certainly not atypical, but sort of worth noting just in kind of the way things move. But when you step back and take a bigger picture on the next page, you've seen this chart from us for quite some time now. This is looking at the valuation dispersion around the world, cheapest quintile versus most expensive quintile. And you can see the rough 15 years for value from 2008 to 2020, right? That's as kind of the dispersions went up and that blue line went up. This is expressed in standard deviations, right? So as the line goes higher, valuation dispersion's wider. And you can see this, the value rally we've seen really since November 2020 with the vaccine. On this chart, it looks like a pretty meaningful move. And it has been, but I would note that because this is in standard deviations, when you go from 4.5 to 2, you're going from the 99.9th percentile to the 94th percentile, right? So 94% of the time, valuation dispersion has been tighter. And I would imagine, I haven't seen the latest uptick, but once this gets updated for the second quarter, I would imagine it's another tick up in terms of those spreads widening out. And what's interesting is this is a large cap slide. When you look at the relative valuation of small cap versus large cap on a P basis, and we've got that. I'm going to skip around here for a second. On page 20, right? And this is looking across the world for small cap P ratios versus large cap. But you can see that that's at an all-time low, or maybe in the financial crisis we were a little bit lower. So you've got wide valuation spreads broadly speaking, and then within sort of small versus large, you have historically low discount or premium for small caps, right? And so we think it's an attractive time for value. We think it's a very attractive time for small cap within that. So we remain pretty excited about the portfolio despite the performance we've seen on a relative basis over the past couple of years. Thinking the setup is a good one for positive real return. Right? It's like Wayne and I were talking about this over breakfast. It's like, it's nice to outperform, but it doesn't feel as good when there's a negative in front of the absolute performance. But we don't see anything in the portfolio as a permanent impairment where, oh, things have fundamentally changed, and it's just that the business we have gone down less, or in some cases gone up, and then we'll get into the details, but they're continuing to execute. We think they're well positioned for the future, and we're pretty excited about that. Page 15 just kind of gives the snapshot of what these cycles look like historically. I call it our spaghetti chart. Each one of these represents a value cycle with time and months on the x-axis and outperformance on the y. And you can see the start line is the current cycle going back to the fall of 2020. And you can see kind of we've had a little bit of a pullback, but it's still broadly in line with prior cycles. And the point here being typically they're about 5 years on average. They've gone much longer. Outperformance is typically 140% relative. We're kind of at the 40-50% range. So, maybe a third of the way through an average cycle, recognizing that no cycle's average, right? But, so a pretty good setup there. Page 17, I think, is always worth highlighting. This is just a snapshot. Obviously, you guys are in our small cap value portfolio in the US, but we do like to sort of give the snapshot of what we're seeing around the world and the opportunity set. Continue to see Europe a little bit cheaper than the US, and if you looked at our global portfolio, you'd see that reflected in the positioning. Emerging markets kind of also pretty attractive, and then we do have an international small cap product that we've been working on as well for several years, and there we see the valuations pretty attractive too. Kind of the benefit of Europe and small cap come together there, I would say. Couple more points on small cap, just because we did some work in our newsletter last quarter, kind of highlighting the small cap opportunity and revisiting it and kind of re-underwriting it. I think the academic research is pretty clear historically. Value works and small cap size works, so when you combine the two, you do even better, and you can see that on 18. But I think more interesting is when you kind of look and dig into what are you getting in the different quintiles of what you're buying, sort of from a characteristic standpoint, on page 19. So this is looking on the left chart here. We use price to normalized earnings as our valuation metric, that year 5 mid-cycle earnings number. So this is looking at our quintiles of price to normal. For each quintile, what's the historical return on equity? What's the historical revenue growth? And then what are you paying for it? And I think one of the things that's striking as you go down this chart is that, with the exception of the 5th quintile that doesn't make any money, so the expensive stocks are, the more hope in small cap land. These characteristics actually don't look that different across the different quintiles. It's really the price you're paying. And that's typically the problem that we're embracing and saying, let's go research this and figure this out. But it's not that the businesses are fundamentally worse than other businesses that you're paying for. And then on the right-hand side here, this is using Ken French's data, kind of just proving out that as you go down the quintiles or up the quintiles, the more you pay, the lower your future return tends to be historically. So I'll stop there. That's kind of a snapshot of what we're seeing high level. See if there's any questions, and then we can dig into the portfolio itself.
See no questions?
All right. Okay. Let's do this. Let's jump over to page 25, and you can see the portfolio characteristics. From a valuation standpoint, 7.5 times price to normal, we view as quite attractive. Thinking of that as kind of a double-digit normal earnings yield in a world where real returns still are challenged. We think that that sets up for future real returns as well. And then on any other metric, looking reasonable versus the index. Market cap a little bit higher than the median market cap of the Russell 2000 value. That's just a function of where the opportunities are. On page 26, you can see the portfolio positioning. So continues to be an economically sensitive and cyclical business. The big thing that stands out when you kind of stare at this chart, two things, one being industrials, which I'll get into in a little bit more detail later, but industrials are kind of a catch-all in small cap, right? So you have fire truck manufacturers, you've got, office furniture manufacturers. It's not just a big cyclical play. There's very specific companies within that making that up. And then within financials, we do have a significant exposure to the banks in the portfolios. It's around 15-16% of the portfolio. We took a very hard look in the wake of Silicon Valley Bank at the portfolio and the bank positioning. I'd say a couple of things. We actually looked at Silicon Valley Bank as a potential investment back in January. And our conclusion at the time was, we looked and we saw this venture funding boom. We saw them tripling their deposits, right? And kind of Bank 101 is, if you're growing much faster than the market, be skeptical. Usually it's on the loan side, not the deposit side. And then in this case, we saw that they bought a bunch of low-yielding securities. So our conclusion wasn't, oh, there's going to be a run on the bank. Our conclusion was, this bank is set up to have very, very subpar earnings for quite some time because of the structure of their balance sheet. Obviously, that ultimately resulted in a run due to the customer concentration in early March. And I would just say that there's some big differences between Silicon Valley Bank and the banks we own. One being 5% insured deposits at Silicon Valley Bank versus, more typical is 50-60% insured deposits, right? With relationship deposits across a range of industries. Another thing is, on the uninsured deposits, they tend to be more commercial relationships. At a small regional bank, like we own, it tends to be a business that makes money. At a venture bank, that was one of the things when we were talking about it back, they were like, well, wait, these deposits are naturally going to run down over time as they spend this money, and the venture market's dried up, so no more is coming in, right? So you can kind of see that tension there as well. And so there are services and relationships there that kind of differentiate the deposit franchise. That said, deposit runs are by their definition irrational, right? And so, we have and we do take the approach of better to own more banks across geographies than to, concentrate your positions in one or two banks. And so we continue to do that. We did make one change within the positioning of the bank portfolio here. We added Synovus Bank, Southeast Bank, right? A bunch of different community banners that they operate under. We actually had owned Synovus, you may remember, several years ago, pre-GFC, or pre-COVID. And we've always loved their deposit franchise. It's very granular. It's kind of very mom and pop, local base. And the issue for Synovus, it was a good issue, was always they were deposit rich and loan. They struggled on the asset side of the business. So they had acquired a bank in Florida that had been growing rapidly on the loan side to kind of make up for that. And go back to my previous comment, immediately we were skeptical. And we said, you know what, we're scared. This is commercial real estate. It's been growing super fast, outpacing the Florida market growth, which already was high, right? And so we said, you know what, we're going to sell out of this when they did the acquisition. So we did. And so it hit our screens immediately in the wake of Silicon Valley Bank. And we said, I wonder what's going on with that loan portfolio. We love the deposit franchise. And if that's where the fear is, let's get there. And so we did some work and then, talked with them. We said, hey, we want to understand, we sold out of your stock because you did this acquisition. How have you guys managed that portfolio since? Like, how's it performed? What's going on with the underwriting teams? And they said, oh, you guys were right. They said, it got really scary with that portfolio and things were about to fall off a cliff. Then COVID hit and saved us. And, all of a sudden Florida, as you guys know, had this huge boom, kind of bailed us out on those loans. We've restructured the underwriting teams. It's now, we have a much different strategy now. And so we took a position in the stock there. We lightened up a bit on our position in Hope, which has a bigger CRE exposure than some of the other banks, just with that controversy there. But that's kind of in financials. Industrials and financials are the two things that really stand out. On pages 28 and 29, from a performance standpoint for the past year, you can see kind of what's been working and what's not. So on the contributor basis, you can see Belden is a network infrastructure business, so all the internet cables that go into building walls, they do a lot of the back wiring stuff and connectivity stuff for 5G rollout, which they've been benefiting from. that stock's been a really strong performer in the portfolio. We've been trimming it, but you see that at the top of the list. Technique FMC from the oil and gas services. If you were to look at, you see energy on a sector contribution being pretty good on the May to May performance. If you were to look at the across 2022 year attribution, you'd see an even bigger contribution from energy. We had pretty big position going into 2022 that we've since reduced as those stocks have done quite well. And then Terex is the aerial work platform company, so lifts, construction driven. That's been a robust market as well. And then when you look on the detractor side, Steelcase shows up as the biggest detractor. This is the office furniture manufacturer. We really like this business. It's consolidated into a couple, we've gone from 5 players to I think it's 3 now, big players. Just office furniture, everyone's still trying to figure out what to do, right? And so we built out a floor. We took on a floor during COVID, but I think we're the exception to building something out versus the norm. And so they're having lots of conversations, less pulling the trigger yet, as people figure out, are we hoteling? Do we have to make our office nicer to get people back? What's the right mix? But we do think that comes back at some point. And very clean balance sheet, very well positioned. So we like that. Olin, broadly speaking, this is a specialty chemical company. Stock's actually done very well. It shows up as a detractor on this time frame, really because one of their end markets is they participate in the chloralkali chain. So they do PVC and caustic soda, and housing is a big driver of PVC, right? So as you've had sort of fears of weakening housing, that's kind of weighed on this stock, but since we've purchased it, I think it's more than a double. So it's kind of just a fluctuation and a timing thing here. Then Geldwin, this is windows and doors. The nice thing is, Geldwin really struggled in 2022 in the back half. Again, I was joking with Wayne, depending on, we could flip back a page and look at year-to-date performance, and you see Geldwin as a top contributor. So things are starting to go in the right direction there, but still have some wood to chop. But we think that the window and door market, they're very well positioned in. They've had a lot of operational issues and execution issues. That there's new management in place. Hopefully we're starting to see some signs of that being behind them and kind of the market structure playing out. And then page 29, you can see we've been busy over the past year. This is a flavor of what we've been doing in terms of the new names we've been finding. I mentioned industrials are sort of a catch-all. So you've got 3 industrials that fit in here. Masonite, door manufacturer, competitor to Geldwin. That fell off and was really weak in the last fall as housing rolled over, but great position. Resideo, this is the old Honeywell thermostat business, so thermostats and home security. And really one of the controversies here was that, well, how much shares Nest in all these smart thermostats taking? And on the home security side, they partner with ADT, and they kind of do all the guts. And you start to see all these ADT and Nest Google partnerships ads popping up. And so we were worried about that. The market had been talking about that. Oh, is this contract going to get renewed? And we talked to ADT and they said, oh, no. Resideo is our best partner. We need them. They just don't have a brand and everyone knows Google. So we give everyone a Google Nest camera and then all the brains of the operation is the Resideo product. So that got us much more comfortable with that, but that was kind of a bit of a fear there. Then Master Brand, this is a cabinet manufacturer, big presence, like 20% market share in the Lowe's and Depot channel, nearshore manufacturing in Mexico, so kind of well positioned, but again, housing fears, right, kind of weighing on that. And then you get something like Adient. This is this seat manufacturer, auto supplier, where a really neat setup here, where OEMs have done well, right? Everyone who's tried to buy a car knows that dealerships and OEMs have been printing money. Suppliers have had the opposite, right? Where volumes are depressed at near recessionary levels. Inflation and raw materials have gone up, and you've only been able to pass through some of that. So you've got the double whammy of operating deleverage combined with inflationary costs you can't pass through. Broadly, it's a 2-player market, Lear and Adient. We like seats because whether you're an electric vehicle or an internal combustion engine, you need your seats. right? So you're kind of platform agnostic. And we think as the chip shortage eases and kind of volumes recover, they're well positioned for both kind of operating leverage and to eventually get some of that price path through as contracts come up for renewal. And then I mentioned Synovus as well on the bank side as an addition. So that kind of gives you a flavor on that side. The sales are all for the good reasons, where the stock is up and has done well.
I've got a question. The
Yeah.
Super Micro, one of our other managers, that's his single biggest position, and I talked to him the other day. He's in a quandary. I think it's up 186%, for the year. I mean, it's just screamed upward because of the perceived value of AI. I'm just kind of curious, what you guys, was it just a price decision in terms of valuation?
Yeah, we got into Supermicro several years ago, and there were two issues. One was a Bloomberg article that said that the Chinese were planting spy chips on their servers, right? And that got a lot of press. And then the other thing was that they were
Did that turn out to be accurate or not?
It's never been proven.
Got it. Okay.
And NSA continued to buy their servers,
Okay, all right.
as did Amazon. So
Okay, all right. Got it.
either no one wanted to admit it, or but either way, I mean, that was part of our judgment. Say, well, wait a minute, if the NSA is still doing business with them, odds are that and then they couldn't file a Q. They had some accounting issues, and we kind of looked at it and said, well, we can kind of look through that.
Okay.
And so we bought it then. Since then, the business, the Chinese spy chips didn't impact the business.
Right.
The accounting got resolved, and then they've had this huge boom, not only from AI, but if you look at the percentage sales they've got going into data centers over the past year, that's been fueling the growth too. So for us, we're saying this is growing faster than we had even underwritten.
Right.
Great midpoint of our valuation. Let's move on to the next thing.
Yeah.
So we were in it when it was in the
dog-
in the doghouse,
Got it,
and
okay.
a problem, and kind of took advantage of that.
Okay.
But,
Thank you, I appreciate that.
yeah, otherwise, you can kind of see what's been going on here. The portfolio itself is in the following
Yes,
page.
Belden, like a rebalance, it got too big.
The trim, yeah, Belden is just, as it's done well, we trim back. So we're buying in the cheapest 20% of the universe. By the time it gets to the midpoint, we're out.
Okay.
And we're always going back to we're always looking for problems.
On the next page.
Here, Belden's doing too well. Some growth momentum manager can pick them up now.
On the banks that you guys still own, given what happened with the Silicon Valley Bank, and, it seemed like a lot of their trouble was the way they invested some of their assets, and maybe they went too far and invested too much in the, lower interest rate securities, and then got hurt as rates rose. I'm sure you've looked at the portfolios for the other banks, and I mean, was that just sort of like a one-off situation? I mean, I know they're going to be subject in a rising rate environment to having some, unrealized losses in portfolios that they invest in. But it seems like other banks have done better at managing those portfolios and maybe not put as much in at the lower rates. And of course, having the run on the bank doesn't help.
Right.
But have you guys seen better management of those portfolios in your other banks?
Yeah, I think that the big thing for Silicon Valley Bank in particular, and First Republic to a certain degree as well, both had deposits coming in. You can see, if you look at liquidity data, a massive influx of liquidity into the system around COVID. So
Right.
a lot of banks saw that. I think with Silicon Valley Bank and First Republic were multiples of that, right? And then they deployed it very quickly. For better or worse, the banks that we own are kind of sleepy, GDP-ish growers, right? And so you're not deploying tons of capital at once at one time. You also look at just the size of the security portfolio, or even at First Republic is also just fixed rate mortgage portfolio versus a C&I book, which tends to be floating, a commercial real estate book, which has its other issues today in the office space, but in terms of the rate exposure, that reprices faster than a 30-year mortgage or 10-year security, right? And so all that mix comes into play. Now, certainly I think, as going from 0 to 5% on rates in a short time period, there is a period we're going to have deposits repricing into money market accounts. And you'll see headlines of deposit outflows at banks. Banks were calling that out back in January, that they were going to see deposit runoffs this year, right? And that's kind of a natural, the deposit spread versus Feds is at an all-time high in terms of the width. Also, the asset yield versus the Fed is at an all-time low. And that takes time to reprice as well. But these banks have more variable loans, so it's a more mixed portfolio over time. So it's, you're not going to get kind of stuck in an inverted net interest margin type situation or something like that. And the other thing with the banks that we're focused on is really the commercial real estate portfolios, particularly office, is where the real pain is. And for the most part, for small cap community banks, it's a lot more owner occupied lending, local businesses. It's not, office towers in San Francisco in the portfolio or even New York. We spent some time looking at office from a REIT standpoint, and looked at some of the big New York REITs and couldn't get comfortable. We had a bit of a scary meeting with one of the major ones where it was, when interest rates go to where they should be, our business will work again. We said, well, what if interest rates don't go to where they should be? They said, no, but they would. It's irrational for them to be here. And we left that meeting saying, no, thank you. Right. The flip side of that is never bet against New York, is what their bull market's saying.
Markets can stay irrational longer than you can stay liquid.
Exactly. So we kind of said, okay, we poked around, but that's a controversy we're not going to jump into.
Thanks.
So I'm just curious, within the New York market, it's got a lot of press. Are you seeing conversions where there be office spaces being repurposed, or is it everyone's still kind of hoping things work out? I'm just kind of curious.
So, what kind of the color is just that the trophy properties are doing well, and it used to be and the A properties, and now you're different. The A asterisk properties are doing okay. Our building that we're in, Mutual of America owns the building. They put 20-30 million into it over the past couple of years, just try to be competitive. They added a gym, a coffee shop you'll see on the ground floor, a nice terrace on the 16th floor. So, we're on Park. You go two avenues over, third avenue is broadly vacant, right? And the conversions are tricky because not every building sets up well to conversion, right? The footprint is just big, and so if you try to put apartments in, you got a lot of rooms without windows. It's the problem. And so you haven't seen much. I've seen a lot of talk. I haven't seen a lot of activity yet there.
And I'm curious, so your lease flat, going up a lot in your own building? I'm just kind of curious.
So we, what was it, a year or two ago, just signed a.
Remember, we're value people.
Right.
We had a need for space, and in the depths of COVID, we got.
I think we bottom ticked the.
Okay.
With some pretty nice concessions for
Yeah.
for the build out.
Okay.
And the building's 98% leased.
Yeah.
Raymond James just took a lot of floors in it.
Okay. Right.
But then the other thing you'll see when you walk, if you walk from your hotel to our office, is the reason why Jamie Dimon wants everyone to come back to work. The building, the new GPM headquarters is going up, and it's massive.
Right.
It is a project. It's kind of cool to watch. And the building next to us, it's all anecdotal, but Ken Griffin just bought Citadel with an option to tear it down and build another mega tower.
Okay.
We're hoping that gets delayed because we don't want to live next to that construction.
Right. Okay. Well, I appreciate that.
But anyway,
all right.
some real estate anecdotes.
Yeah.
Yeah, it always helps.
Because the overall vacancy rate's in the mid-30s, isn't it?
I don't know if it's that. I don't know quite where it is overall for the city. But it's really like the B and Cs are really struggling.
They're the ones that are hurting most, yeah.
The what? I'm sorry.
The B and C.
The B and C rate, yeah.
Yeah. Okay. Very good. Anything else? Any questions?
Hey, John, I didn't hear in any of your metrics any consideration of dividends. And Synovus, for example, is up around 5%, I think now. Does that enter into your considerations?
Not explicitly. So we look at, when we're looking at the business and kind of the evaluating, we're certainly looking at capital deployment and what the history is, whether mix of dividends, buybacks, to the extent there's been good M&A, though we're more skeptical about, tuck-in M&A tends to be okay, but transformational scares us a bit. So we're more looking at capital allocation as a bucket versus what the dividend yield happens to be of a given stock. That said, we're happy to collect a 5% yield on things, and kind of our view is if you can collect 5, 6, 7% dividend yield while things get better, even better, and helps drive the returns. But it's really looking at the capital needs of the business and kind of what they're doing and kind of evaluating that versus explicitly looking for high dividend yield.
Any other questions from anyone here in the room or remote? Seeing none? Gentlemen, as always, thank you for the long-standing 2-decade relationship. I know that's, but we have a habit of keeping people around, so we're very glad for your contribution over the years. So.
We appreciate it. Thank you. Good
Any
seeing you,
other
everyone.
questions? I don't. I'm good. All right.
Thank
Fantastic,
you.
gentlemen. Thank you very much.
Terrific.
Safe travels back.
Thank you.
All right.
Average yield of 4% is not bad.
And financial gap.
Yeah.
I think that's the 212 number. Yes, Chester. Farias, are you with us?
Brandon?
Farias, yes. I'll be in touch.
Yeah.
Yeah.
Good morning.
Thank you. Travel.
Good morning, can you hear us?
We can. Is Maria Clark and Jenny Bork here?
Great, well, welcome. So you have the floor. As you know, we tend to ask a lot of questions. We're a rather inquisitive group, so if it's okay with you, but please go through your presentation. But if it's okay with you, if we have questions, we'll stop and ask them as we're going through, if that's okay with you.
Yes, that would be great. We'll keep it pretty dynamic. Thank you again for asking us to present. Most of you know us. We've been down there many years. It's again Farias Park and Jenny Bork presenting. If you all have the presentation material, I think we generally keep the conversation to 20-30 minutes, and I'll pause along the way for for questions. But why don't we pick up on page 3 to 5? Those pages will cover some organizational updates, and then I'll pause. We are still a one-product firm at Colchester. Page 4 reflects the left side, our client base, which continues to be endowments, foundations, and pensions. We remain open for new business. Right now, we're still allowing money to flow out of the program. We just think that that's a prudent discipline. We've done that since 2013. We've allowed the equivalent of the dividend yield of the portfolio to flow out each year. The dividend yield is 4%, so 4% of about 40 billion, which is what we're managing, is about 1.6, and that is our target outflow each year. I would say at the end of, or since June 1, the outflow has been about the net outflow has been 1.2 billion. So we'll see where we end up for the remainder of the year. But we've taken in, a good amount of money over the last 3 years since we opened for new business, and we've also had some redemptions with 750 clients and 40 billion. We always have clients rebalancing in the portfolio, so there's activity every month. On page 5, that's everybody in our organization, so there's no one else. There's only 25 of us, and we like to keep the team pretty lean. And you can see there the goals are partners, so the majority of the firm are partners, and that's the way we like it. The most recent developments have been Alex Marquini on the investment side, made partner, and a couple of other people at the firm were invited to the partnership pool this past March. The alignment continues to be very strong with our clients. We have 1.5 billion of our own money in the program. We pay the same fees our clients pay. On top of that, we are all required to invest a minimum of 10% of our total comp into Silchester shares every year. And those shares can't be redeemed. So that's a form of permanent alignment with our clients. So we think this is a prudent discipline to really transition Silchester for the next 30 years. And on the investment team, you'll remember we have 10 investors who all write research. And today, all 10 also make decisions on the portfolio. Stephen, Michael, and Bertrand are our founding partners. Stephen works 3 days a week. Michael and Bertrand are still every day. But it is fair to say over the last 10 years, we've transitioned those responsibilities to everyone else in the organization. So Akiko down to Delia on the investment team have really taken over the day-to-day management of the investment side. But we still have Stephen, Michael, and Bertrand there for guidance, and they also sit on various investment groups that we have. So I'll pause there. Also, just to clarify again, we did make this announcement. One of our members is ill, Michael. He has an illness, and we've given him some flexibility to work from home or take time off if he needs it. He hasn't really exercised that to a great extent. He's been out about 1 day a week when he goes for doctor's appointments, but other than that, he's been in the office. He's situated himself to be about a 10-minute walk to the office, really, for many years now. And comes in each day and is still writing research and voting at our portfolio implementation group and making recommendations for the portfolio. But just in full disclosure, I wanted to mention that again, even though we have announced it to all of our clients and consultants.
Great.
So if there are no questions there, I'll do a high-level review of the philosophy and process from 6 through 9, and then we'll jump into the portfolio.
Great.
So Jenny, you want to spend maybe like 5 minutes there, and then I'll go to the portfolio?
Yeah, absolutely. So this is Jenny speaking now. I'll pick up and just make a couple high-level comments as Bree said of philosophy and process. You guys have been with us since 2003, so you know us well. But remember, we are value investors, and we focus on intrinsic value by buying quality companies at good prices and through the various rotation work that we do. So we are looking for a synthesis of price and quality. If you look at page 7, that just shows the pricing side of that. That chart on the left is basically our back test. You've seen this before, most of you. But basically it says you invested $100 in 1980. That $100 would turn into a little bit over $6,000 at the end of 2021. But if at the beginning of each year you've been able to invest in the cheapest part of the market, on either a price to book earnings or yield basis, you can see the premium that you would have captured. So essentially that gives us comfort that we are fishing in fertile waters by looking for companies in the cheapest quartile of the market. What we do each month is we run a screen looking for companies in the cheapest quartile. Companies must be in the cheapest quartile on either price to book, price to earnings, dividend yield, or EV to EBIT. They must be a cheapest quartile, one of those metrics to make it through our screen. Once the list of companies comes through the screen, the entire investment team looks at that list and submits proposals for research. And then the research group, which is now led by John Burke, looks at all those anonymously submitted proposals, and research assignments are sent out to the group. Typically, an investment team member will write about 20 research reports a year. Once we look at the research reports, we get to the quality side, and that's shown on page 8. So essentially, when we're looking at the quality of a company, we're trying to understand a company's free cash flows, and how does a company generate free cash flow, and what might threaten, protect, or augment future cash flows. This chart on page 8 is basically a summary of the discussion that's held by the investment team every Tuesday morning about 4 different companies. So a discussion will be held about a company, looking at that company's quality criteria on these 3 major metrics: capitalization, free cash flow generation, and stewardship. So how you would read this chart, this is based on the discussion of one company, is that the team generally thought that on capitalization it was average, on free cash flow generation it was average, and on stewardship slightly above average. There were 9 people at this meeting. That's why the little white numbers in the green columns add up to 9. At that Tuesday morning meeting, it's just a discussion about a company's quality. But you do see the metrics there on the bottom because we do want to pay attention to both price and quality. Every research report is very consistent. There are many subcategories underneath each of these 3 categories, but that is essentially how we understand the quality of a company. And then kind of putting it all together on page 9, a high-level overview. We have our monthly screening from FactSet, that's the opportunity set. Proposals are submitted for research. Research is done. Every Tuesday morning, the entire investment team discusses 4 or 5 research reports or 4 or 5 different companies. They then make quality assessments on those companies. And you might remember when decisions are made, when votes are taken, they are anonymously. They're anonymous. Everyone has an iPad in front of them and makes their own assessment, and no one knows what anybody else is voting. And that's very important to us because we don't want anyone to be unduly biased by anybody else's vote. And we do have just one vote, one person. No one's vote is more heavily weighted than anyone else's. Once every 3 weeks, the entire investment team meets to make portfolio allocation decisions. That's the portfolio implementation group. Again, discussions are held and anonymous votes are taken. And based on the decisions made in the portfolio implementation group meeting, then a smaller group, which is really right now Amber and Kitty working on a different schedule, week to week. They will then take the decisions made by the larger portfolio implementation group and work with our dealer to execute them in the market. And that ultimately gives us a portfolio of about 130 names, which we are actively trimming, topping off each day. We're buying and selling about $80 million each day, so quite active there. So that is an overview of our process. Really, since inception, nothing fundamental has changed with our philosophy and process. We have certainly made little tweaks along the way to improve things with our process, but things have remained relatively the same since the start of our program.
Jenny, I have a question for you on page 8. The quality assessment, the rankings that you give for above average and below average and below average, is that in comparison to the universe of investable companies you're looking at, or is it a smaller group that you're comparing it to the proposed or the candidates group?
No, it's compared to the entire universe.
Okay. Thank you.
So when we vote on, for example, this BMW, we are saying it's not, the balance sheet is not average compared to other autos. It's average compared to the opportunity set.
Okay, thank you.
Anything else we can clarify for you on process or philosophy?
No, you've done a good job, and we're pretty familiar, so thank you for that refresher.
Okay, great. So why don't we move on to the portfolio and pick up on page 11. And I think you all know we don't go through the whole book. We stop on page 18, so don't worry about time. The rest of the charts are for appendices or questions. So just picking up on page 11, what we're looking at again is the growth of intrinsic value. And at Silchester, that term is not amorphous. It is defined as the growth of earnings per share, dividends per share, and assets per share in the portfolio. So whenever we put a company in, we're trying to understand through our bottom-up fundamental research how this company is going to grow its earnings, assets, and dividends. We've taken the portfolio in aggregate and plotted it out for you since inception. So the red X plotted, or the red and the blue and the green line on the left side reflect the Silchester portfolio. And how you would read that is really to show that earnings in our portfolio have been the most volatile. Book value has been our biggest workhorse, and dividends have generally tracked the earnings. And over the last 3 years, we've grown intrinsic value at 5% per annum, really through difficult economic times with COVID and then supply chain issues, which were then exacerbated by Russia's invasion of Ukraine. You can see earnings fell in 2022, following really a strong post-lockdown rebound that we had in 2021 after the height of COVID. We've been buying a bit more cyclically depressed names that we do expect to mean revert. We'll go through some of those purchases in a few pages, but that's why that red line's coming down a bit. Book values continue to rise through COVID, so I think we're seeing a bit of normalization there with the blue line coming down. Dividends are still increasing in the Silchester portfolio. We take a straight average of those three numbers on the left and call it intrinsic value on the right. So that black line at 12.3% per annum is a straight average of those three colored lines. So you can see how we propelled that compared to the index. And again, why that's so important, on page 13, if we just skip over 12 for a minute, you can see the correlation between the two lines. That black line on 13 is the same one as on 11, but plotted with our long-term performance. And City of Gainesville long-term performance is quite similar to that red line anyway. You joined us in 2003. This is since inception, but the performance has been pretty similar. So what we're saying today with that gap is that there is scope for the portfolio to improve based on where our intrinsic value of the portfolio is today. Now this page is through the end of March. We're up about 12% year to date. So we'll see a little more of an uptick with that red line once we take this book out one more quarter. On page 12, what that reflects on the right side is this continues to be one of the cheapest portfolios Silchester has had since inception. And I think probably most value managers can say that. It's been, a difficult time for value, but we don't believe we've sacrificed business quality. We have better balance sheets than the universe median. We prefer good stewardship. We focus on the normalized through the cycle earnings of businesses. So even with more cyclical and capital intensive names in the portfolio in recent years, we still have a quality portfolio. So we think not only is it cheap, and you can see those current multiples on the bottom, 13.7 PE, book value of 0.8, and the dividend yield of 4.5. And you can see how that compares to our average. So in the last 6 years, it's been below Silchester's average. So on an absolute basis, we're very cheap. On a relative basis, we're also very attractively valued. EFI's PE is 15 times. EFI's book value is 1.7, and EFI's dividend yield is over 3%. So if we go to page 14, this is some of the activity in the portfolio for the last 6 months ending March 31. And to remind the group, most of Silchester's activity, we buy and sell about $80 million each day, but they're trims and top-ups of names, very incremental buying and selling and tinkering around position sizing, rather than going in and buying a full position or completely selling out. We take our time, we're very patient buyers and sellers, and this is a reflection of that. So what you see on the right is in aggregate, dividend yields trimmed of 3.7, PEs of 22 times, replacing them with cheaper PEs and higher dividend yields. The book values in this period are not as attractive for the companies we bought because there are several pharmaceutical names on the left which are not book value plays, like Novartis, GlaxoSmithKline, GSK, Roche, Bayer. They tend to be more look-through PEs and dividend yield plays in the portfolio. Again, our decisions are based from the bottom up, company by company, but in this period, we have rotated the portfolio to more European positions. And as you can imagine, with the volatility in Europe, due to the invasion of Ukraine, the energy crisis, inflation, we've picked up 3 new names in Europe, which are in bold. Covestra is a German business, which is a polyurethane business. It makes plastics and polycarbonates for various end products like cars and electronics. It's a German business. Schroders is a UK asset management company. Philips is a Netherlands-based global consumer branded business, and we know it's a lighting, but they are restructuring their business to more healthcare. So those 3 names are European, and actually most of the names on that left side are European names. Colruyt is another new name, not in this period, but we did buy last year, which is a leading Belgian food retailer. And with inflation issues right now in Europe, it's been hard for retailers, and we were able to pick that up at some sort of nice multiples in the portfolio. The free cash flow yield of Colruyt there, halfway through that list on the left, is about 6.5%, which fully covers that dividend yield, which is close to 5%. In terms of any other themes that maybe are emerging in the portfolio, I would say on the back of some of the issues of with the invasion of Ukraine, we sold and trimmed some of our defense businesses in the portfolio. So those are reduced. You can see even on the right, the 4th or 5th trim is BAE, which is a UK defense company. We've trimmed a few financials in the portfolio. Obviously, there's been, some news out there with the collapse of SVB in March. None of our trims are based on that. If I have to single any one of the companies on the right out, it would obviously be Credit Suisse. That was a very poor decision on our part. We held on to the very end. We, had always sort of stuck with the investment case that we had was, it did have a good wealth management business. We were hoping there could have been a sum of the parts argument and breakup of the business. We actually were in Switzerland meeting with management in the first quarter of this year. It didn't pan out the way we were hoping. It was not a very big position at the end. It was a 0.7% position in the portfolio, and those assets did get absorbed by UBS, which is in the portfolio, and you can see that is the 6th trim in the portfolio. We're not too concerned with UBS. It kind of went in a very different direction than Credit Suisse did after the global financial crisis. It really did focus on its wealth management business, and it's very well run. We're happy with that. The trims are just simply based on valuations of those financials you see on the right. And it is also fair to say that Silchester's financial exposure is a little bit different. We have 7% in banks, but those are primarily very regional banks. We have about 4 or 5 Japanese regional banks, which simply do deposits and lending in their prefecture. We have a small Danish bank, Danske Bank, that is another small regional bank. And then we have asset managers like Manfred, Jupiter, Janus Henderson, Schroders, which have really good free cash flow or low capital intensive businesses. So not your sort of big conglomerates. I think the biggest diversified financials were Credit Suisse and UBS, and now it's just UBS.
And just a question, on the company sold page 14, some are bolded and it says the aggregate of companies sold. Is that a full sale, or is that, well, that was a significant position that was sold? I'm trying to understand what the difference between a full sale and a trim.
Exactly, thank you. The bolded are full sales on the right. The rest are just trends. We
Okay.
still own all of the ones that are not in bold.
Okay.
And on the left, the 3 in bold are new names in this period. The rest are just top-ups of existing names.
Gotcha, thank you.
Not too much to say on page 15, except to remind everyone that these concentration levels have been pretty consistent. We like to have a name of about 120 to 140 names. You will never see Silchester with a 50 stock portfolio. It's just not our style. But the top 50 have consistently been between 60 to 70% of the portfolio. But we like that tail because of that tinkering around position sizing that we do each day. And one thing I did not mention is we've quantified that 50% of that black line we looked at on page 13 comes from that daily rotation. So 50% of our intrinsic value growth comes from that daily tinkering around position sizing. Trimming companies that have higher valuations and buying cheaper valuations increases that intrinsic value of the portfolio. So it's a very big component of what we do, and that is easier to achieve with a 130 stock portfolio than it would be with a 40 stock portfolio. We're also not the type of managers who think we can pick the winners. Maybe some people out there think they can. We are not that type of manager. If we see a cluster of similar names, we will do our fundamental bottom-up analysis on all. If they all have a niche and they're all trading cheaply, our style is to buy all of them. And then over time, you will see that the names are very dispersed. Like we have an auto cluster, but Honda's our #1 position. And then Mazda's somewhere else in the pack, BMW somewhere else, Yamaha Motors somewhere else, Hyundai somewhere else. So some rise and some fall and some get fully sold. On page 16, this is our country allocation since inception. Gainesville joined us in 2003. I think you can even see the change since then, where we were rather Eurocentric, and now the majority of the portfolio remains in Asia. 44% of the portfolio is in Europe today. The majority of the Asian exposure is Japan. We have 35% in Japan. It is 48 stocks out of the 129. Very diversified group of names with various market caps, various industries and sectors. We are an all-cap manager. So really, our playing ground is just outside of the U.S. Where are we finding the best use of our capital? So today we have about 13% in pure EM, but they're not really frontier markets. They're more developed of your EM markets, like South Korea, Taiwan or Greece, rather definitional if some of those should be down there. But 13% represents that emerging market exposure today. We are no longer screening in China. We made that decision at the end of last year. We have continued and will continue and have historically always gotten our Chinese exposure through Hong Kong anyway, and that remains consistent. You can see the Hong Kong exposure there in that Asia area. And we'll get our exposure obviously through some of our Taiwanese names. But the China screening was taking up a lot of names, and those names never seem to make it into the portfolio for either transparency reasons or access to management, rule of law. And so we decided if we didn't screen there, we would get more viable names that could make it into the portfolio. And we would continue, like I said, getting our Chinese exposure through some of the other names that we have.
Farias, could you comment maybe on, I don't see India listed here anywhere. Could you maybe comment on how you guys look at India and whether you would, screen companies there at some point?
Yeah, so there are a few companies that we remove from our screens. Russia has always been one of them, not just in the recent disaster, but since inception we did screen there. India we did. We've taken a few trips there. One of those trips was to visit several banks. One of the trips was to visit several IT businesses. But in the end, the banks were trading well above book value that we didn't want to participate. And those IT companies were too sort of expensive. So we found it a very difficult market to make investments in. So we've never had exposure there.
Thank you.
Farias, I was just going to ask about your UK. Sorry, Farias, can you hear me? I was going to ask about your UK exposure. I know you're generally bottom up with your decisions, but I'm just curious with kind of a macro overlay. The Bank of England just sort of surprised this morning with a 50 basis point increase. So I was curious how you guys thought of UK or broadly Europe and where they are in the interest rate and inflation part of the cycle, and kind of how, if at all, that impacts your allocation decisions. It's a fair comment.
Let me give you just a top view first. As you know, in so many years, we feel we invest in companies and macro environments have implications on these businesses. Politics, decisions play a part too, but in the end, the assets are the same in the business. When we look at companies, we look to see how that inflationary environment or high interest rates are going to impact the sustainability of earnings through a cycle. And when we have looked at all of our companies, we have always used a 6% interest rate on debt as a default assumption. Now that's very high in the recent period, the last 10 years or so, but we've always been very conservative. So even with the recent rise in interest rates, rise in inflation, we see that as more reverting to the mean, but we've been always conservative in how we've thought about through the cycle earnings for the portfolio. So we have not had to make any adjustments with, government interventions in terms of either raising interest rates or interest rates for banks. So I think we feel there would not be any changes to the portfolio based on that.
Thank you.
And then, not that you asked this, but just to make a comment, 35% of the portfolio is in Japan, and inflation there has increased to about 3%. So obviously, they're not even going through what we are here, or what Europe is going through in terms of, the inflationary environment we've been going through in the last sort of year. The other point, just to mention again, is that we stay fully invested. Silchester does not hold cash. Even in volatile markets, we think that could be permanent loss of capital for clients. So we are fully invested. And then, which just means that when there's a buy decision, there needs to be a counter sell decision somewhere. Or, dividends coming in to buy what we want to buy. On 17, again, it's similar to 16, where the ranges on 16 and 17 are our guidelines. They're very broad. And then those weightings are simply, again, a byproduct of quality and price, but clearly are different than when, Gainesville started. The one thing that is pretty consistent is when you started energy was 0 and today it's 0. But you can see in between where we were. And that is simply due to the valuations of the two major energy companies we've held really for the longest time, Royal Dutch Shell and Total. They were both trading at 25 times on a look-through earnings basis because really the rise in energy prices over the last few years, it caused us to sell out of our two names and get our sort of energy exposure indirectly to some of our other businesses. Consumer staples has increased a bit in our portfolio, largely due to buying a bit more of Tesco, the UK grocer, also the recent purchase of the Belgian food retailer I discussed. Consumer discretionary has picked up because we bought Yamaha Motor in the last year. We also, obviously the largest position is Honda Motor. We own BMW, Hyundai, Mazda, and then various component makers in Japan that make parts for cars. And what's reduced slightly is some of the financials. Healthcare has been pretty consistent, but that's European healthcare, primarily Sanofi, Novartis, Glaxo, Roche, and Bayer. And then I'll end the presentation just on 18. Jenny will give you some updated figures, I think, through Friday.
Jenny, well, actually, we have year-to-date from yesterday, 12%, so on par with EASY. The figures that you have in your book are through end of May. But 12% through yesterday, year-to-date.
It's been a good month for us.
And I'm curious, you just macro, we talked macro, but obviously you've been purchasing Japanese companies. There's been a lot of interest in them recently. The overall market's up, I think, around 30%. Again, valuations you still think pretty compelling, given your allocation in Japan?
Yes, we do. Our book of business in Japan is trading at 0.7 times book value. So those 48 names, that is very attractive to us.
Okay.
It is, obviously our largest EC market division. We find businesses are very operationally well run, and it is fair to say in the recent years, we have been seeing nice movement on corporate governance as well, where we're now actually seeing a bit of PE support and even some dividend yield support. It's not where we'd like it to be. It's certainly not the, European or American style company, but there's been progress. And now there are even Japanese indigenous organizations that are following more of an American model of targeting ROEs of 10%, having independent directors on the board. The Tokyo Stock Exchange has 400 companies that abide by certain of these requirements. So now there are indigenous companies and not just Americans coming in and saying, this is how you should run your business, but people they can emulate even there. So we are happy with the book of names we have there. And you're right, I think this month some of the outperformance has been through some of our Japanese names, but I can't quantify that just yet because the month's not over and we don't have attribution.
Sure. Okay. Well, thank you for that.
So those are the main points that Jenny and I wanted to make. There are other charts here if the group has any questions. Charts on our market cap weightings, on the balance sheet structure, on some, revenue exposure by country or alignment. So happy to address any questions the group might have. It's been a very long-term relationship and we're very appreciative of it.
I don't, any questions here? I don't see any in our conference room. Anyone else remotely? Any questions? The one question I do have, and it goes with the currency, and I'm trying to recall how do you hedge or not, or how do you manage that?
Sure. Let's use 27 to talk about that.
Okay.
We are allowed to hedge up to 20% of the portfolio by our guidelines.
Okay.
We have not had any currency hedges on the portfolio since the end of 2008. And the reason is because of this chart. We buy this graph from Colchester, one of our global fixed income affiliates. Mm-hmm. And what it's saying is that most of the major currencies today are weaker than the dollar. Mm-hmm. So not only are we picking up cheap valuations, but Colchester's also now getting cheap currencies. So given where that red X plot is today on the right, we would much rather own the portfolio outright than put any currency hedge on it. If the Japan yen was where the Czech kroner was and even higher, we would consider hedging out of yen into one of the weaker currencies.
Great. Thank you.
Sure.
So it's given that assumption that perhaps the difference in, the strong dollar versus weaker relative currencies, that could be somewhat accretive for a U.S. investor. Is that a fair assessment?
Well, we think of it as a positive for the portfolio that, the weaker currencies are a benefit to the portfolio along with what we're picking up in terms of cheap multiples.
Got it. Right. Okay.
So if the company was if the currency was expensive and we had a significant weight, then we would think about hedging out of that currency temporarily and hedging to a weaker currency, knowing that, these currencies mean revert. And I guess, in fairness, our thinking also is that hedging is expensive. We're not currency experts. We think sometimes that managers like us hedge, companies hedge, clients hedge, and it could be a zero-sum game. Mm-hmm. From inception to the end of 2008, we did have a hedge. It added 20 basis points per annum to performance. But that was over the long run. At certain times we lost money. We ended up making it back in the long run. But we feel over time, with our long-term nature and our clients' long-term nature, they really don't have a currency risk.
Okay. Thank you. Any other perspective or comments you want to share with us?
No, Jenny, any other? No, I think that was a pretty thorough overview of where the portfolio is.
Agreed. Any additional questions from anyone else on the board or staff members? I love your chart on page 30 between BMW and Tesla. It tells an interesting story. So thank you for providing that.
Oh, yes. Yes, that is, thank you for pointing that out. That is one of the relatively newer pages in the book, and we put, just for our clients to understand what do we own versus, what's been rewarded in the last few years.
Right. So that's great. Well, I appreciate that. Well, look, I have, again, as usual, you guys did a wonderful job. We appreciate the long-standing relationship. If there's no other questions, you can get back to work, and we'll continue the meeting. So thank you again.
Thank you so much.
Thank you, everyone.
Thank you. All right. Let's see. Brendan?
Good morning.
Good morning, sir.
Well, after the crush of paper that we had last time, I have a lot lighter presentation for you this time. Really just have the May 31 flash. And what's interesting is, kind of last month or in the prior quarter, we had big positive returns but relative underperformance. Now here in the month of May, you had the markets actually sell off a bit, and we had significant outperformance on a relative basis. I'll just touch on page 3 really quick, talking about the asset allocation on the bottom left-hand corner. And you will see overweight, largest to the large cap U.S. equity, with the second to our smaller mid-cap equity. And William or I, we can touch on some of the kind of the rebalance that was directly related to those overweights. But as you move down to page number 4, again, it was a negative month, but we did outperform. So the portfolio was down 11 basis points for the month of May. The benchmark was down 90 basis points. And for the, arguably the most important number, the fiscal year to date, just short of 18% versus that benchmark of 14.5%, which again is a wonderful recovery from what was a terrible 2022 fiscal year. And then as Silchester kind of just mentioned, so far in June, we've actually had a very nice recovery. So rough math, we're probably up somewhere in the neighborhood of 4% since the end of May. So that fiscal year-to-date number is somewhere north of 20% as of this morning. As you move down to page number 5, which is touch on the individual managers. And again, although the total fund did well, we did have some volatility within some of the individual strategies. So Twin did nicely, 43 basis points ahead of their benchmark. Barrow Hanley, very similarly, was up by about 45 basis points over their benchmark, still down 3.4, but their benchmark was down 3.8. Brown, the one area where we did kind of see positive performance was large cap growth. They were up 2%, but the benchmark was up 4.5. Really a continuation of what we've seen in particular the last 3 or 4 months, where 4, 5, 6 stocks driving the market. If you don't own those at market weight, you're behind. The breadth has been incredibly narrow within large cap growth. So that continues to be an issue, not only for Brown, but really all managers within that large cap growth space. Pzena, who you just heard from, down 2.6 versus 1.97, so a little bit behind. And then the real standout is DGI. Look at that the month, 13.1 versus essentially a flat benchmark. And for the last 6 months, 13.7 versus 1.6. So, obviously you guys said the right things when they were here a couple of months ago, because clearly that performance was very good. Honestly, they've been very good for a long time. I'm joking, but just that coincides with them being here, and then all of a sudden, a couple of months later, you've got some fantastic performance.
I'm surprised with Barrow Hanley being down for the year in this environment, because they were tracking pretty well. Anyways, just
yeah,
it's not a big deal. I'll just
certainly, part of that is the bank and financial exposure,
Yeah, sure.
and the like. But yes, they have, relatively speaking, for the last 12 months now, about 0.25% behind. Silchester, who you just heard from, again, relative outperformance, but that was down 3.8 versus the 5.4. And then Bailey Gifford, similarly, down 2.7. Their benchmark was down 3.08. So a little bit ahead, but again, the more recent update, again, it's still loose math, but certainly moving in the right direction in terms of each of the broad market strategies. Loomis, fractionally ahead, but again, notice the down market, we did actually see interest rates pop up just a little bit. within the month of May. And then the last one, it shows as a negative. Principal, we value monthly, we get statements, so they're down 21 basis points versus the index, which is flat, we only get that quarterly. So that's a little bit of a mislead there. I'm sure the index was negative. But again, overall, certainly because of the fantastic performance from DGI in particular, but again, Silchester, Bailey Gifford also doing well. Very good month and a very, very strong fiscal year-to-date period, which is again at stronger yet as of today.
William, when's our fiscal year end?
September 30. So yeah, we'd like to try to hold on to it.
Yeah.
But, you know, summer's not always the best time in the markets, and we'll see how how the markets react to the Fed if they start raising rates again in July. But we'll just see.
Yeah, well, the old adage is sell in May and go away.
Right.
So June has been a very, very positive month so far. And just to kind of update the committee too, as we were getting to the end of June and needing to kind of rebalance, last week we already initiated the process to essentially pull $32 million out of U.S. equity, because that's by far the greatest overweight. The larger portion was coming out of the large cap section, and the slightly smaller on the small and mid, kind of proportional to the overweight. But again, selling at sort of recent highs and using that money for the end of quarter cash, as well as a little bit of a rebalance back over Lewis.
Great. That's
Yeah,
helpful.
so we took 12 million out in cash, which may be a little bit more than we need, but, you know, I still don't feel like our trial balances from the general ledger are completely correct. And so we took out a few million more than we might actually need, but, you know, we'll look at it again in August and September and see what we need to take out for the fiscal year end. And just to remind you, we're not allowing the internal cash balance for the pension plan to go negative like we used to. Our accounting/finance director prefers not to do that, so we're abiding by that instruction. We did shift 20 million from U.S. equity to Loomis for fixed income, so that brings us up to almost 5%
Okay.
allocation there.
And we can talk about that, again, that's what, take from the rich, give from the poor, take from the overvalued to the less, the unfavored, that usually will work out well for you, so.
And it's dry powder for the same thing, you know, as we approach the end of the 22 fiscal year, we didn't want to be forced sellers of equity when it was
Absolutely.
down, so we pulled it out of fixed.
Makes sense.
And kind of refilling that bucket to be prepared for if and when that happens again.
Okay, great.
Any questions?
Well, Loomis, they're gonna start rolling over into new issues that are better return, because, they like 3 to 5 years is the bulk of their investment, their bonds?
You say in
For
Loomis?
In Loomis, yes.
Yeah, I mean, obviously you're continuing to roll certainly longer dated securities that are.
It just hasn't shown up.
Well, yeah. I mean, again, you've got the overall duration of the portfolio. And in the short run, the biggest impact to performance is just going to be what interest rates do and what the duration is in the portfolio, kind of swinging that around. But certainly the higher yields are there, so that, you know, that is a positive. You just need interest rates to sort of settle down, or fall. I mean, if interest rates fall, then you get the bump on that side as well. But we did see, at least within the month of May, yields pop up quite a bit.
William, anything else? Greg, anything else you want to share?
I don't think so.
All right, then it looks like we've blown through the non-agenda that we didn't approve, but I guess I'm willing to close the meeting, so we'll go ahead and terminate the meeting. Gentlemen, thank you for joining us remotely, and we'll see you. Yeah, well, when is our next meeting, William?
August.
August, very good, thank you.
Safe travels, everyone.
What's that, Dave?
Dave Rayner says he'll try to be at the next meeting.
Okay,
All right.
well, thank Dave for us.